Welcome to this comprehensive tutorial on the basic principles of accounting. This video will guide you through foundational accounting concepts with real-world examples that anyone can understand, whether you're a student, an entrepreneur, or just starting your accounting journey. Let's get started. Accounting is the language of business. It involves recording, summarizing, and reporting financial transactions. This information helps business owners, managers, investors, and other stakeholders make informed financial decisions. The core of accounting is the accounting equation: assets equal liabilities plus owner's equity. Assets are things a company owns, liabilities are what it owes, and owner's equity represents the owner's stake. This equation must always balance, and it's the basis for double-entry bookkeeping. Double-entry accounting means every transaction affects at least two accounts. One account is debited, and another is credited. This keeps the accounting equation balanced. For example, if you buy equipment with cash, you increase assets, equipment, and decrease another asset, cash. Let's dive into the fundamental accounting principles that guide how financial data is recorded and reported. These principles ensure clarity, consistency, and transparency. The accrual principle requires recording revenues when they are earned, and expenses when they are incurred, regardless of cash movement. For instance, if you perform a service in December but get paid in January, the revenue is recorded in December to reflect actual performance. Example: invoice issued in December, cash received in January, with arrows indicating timing of revenue recognition. The consistency principle requires using the same accounting practices over time. This allows financial statements to be comparable across periods. If a company switches methods often, it becomes difficult to track trends or performance. The going concern principle assumes businesses will operate into the foreseeable future. This means assets are recorded at cost, not liquidation value, and depreciation is spread over the asset's useful life. The conservatism principle advises caution when faced with uncertainty. Accountants choose methods that minimize the risk of overstating assets or income. For example, potential losses are recognized when they are probable, but gains are only recorded when realized. Under the business entity principle, a company's financial records must be kept separate from the owner's personal finances, ensuring clear accountability. The materiality principle states that only information substantial enough to affect decisions should be recorded. Insignificant expenses or transactions might be omitted to keep financial statements clear and meaningful. The accounting cycle follows 8 essential steps, starting with identifying transactions to preparing post-closing financial reports. Let's briefly walk through each step. Suppose your company purchases office supplies for $500 cash. First, you identify the transaction, then record a journal entry debiting supplies expense and crediting cash. Next, post to the ledger, update